Welcome to Coaching Smart. Our aim is to get you informed in the areas of your interest. Where the telescope ends, the microscope starts. Coaching Smart, we coach how to study maths, accounting, research, and technology. Our area of first coverage will be covering accounts. In accounts, we'll be handling the following sub-areas. 1. Introduction to accounts. 2. Principles of accounts, which builds the foundation. 3. Accounting cycle. 4. Cash book. And then finally, the manufacturing account, control account. Let's start with understanding accounts. For us to understand accounts, we need to get the definition. There are 3 phases of accounts. 1. Recording. 2. Accounting. 3. Auditing. According to AAA, accounting is the process of identifying, measuring, classifying, analyzing, and interpreting accounting information, which permits judgment and decision making by the users of information. To make it simplified in a summary form, we can say account is the process of recording, analyzing, and interpreting accounting information for a given period of time. What are the functions of accounts? Number 1 function is recording of business transaction. 2. Classifying of business transaction. 3. Analyzing and interpreting accounting information. Then 4. Preparing policies and plans for the management and control of business undertaking. Then finally, it provides information useful for government to impose taxes. Now, can we look at the users of accounts? Who is a user of account? They are people or organizations which make use of accounting information. There are 2 types of users of accounts. 1, internal user, and 2, external user. Now, these are people who consume information. The internal user, they are people within the organization who make use of accounting information for management and control of business. That means decision making. Number 1, owners, stock shareholders. 2, management. 3, employees. So these are people who need information, accounting information, to make particular decision. And the decision can be for expansion purpose, for disposal purpose, or for winding up the business. External users. Who are the external users? Number 1, they are people or organization outside the organization who make use of accounting information for decision making. And who are these people? They include 1, investors. 2, customers. 3, employees. 4, lenders. 5, suppliers. 6, government. And finally, auditors. Terminologies used in accounts. When you talk about terminologies, we are talking about the language of business, the language of accounts. Now, which are these languages? Number one language of account is asset. What do you mean by asset? Asset is an item which generates income for a longer period of time in a business. And there are two types of assets. We have one, fixed assets, two, current assets. Fixed assets are used for a given period of time. Current assets are assets which are easily convertible into cash for business management or running of the business. Two, we have liabilities. What are liabilities? These are business items which are supposed to be paid by the business when they make use of capital. 3. Capital. Capital is amount of money which is used to start a business. Without capital, no business. 4. Debtors and creditors. Debtors are those people who owes business money. When you talk about creditors, these are people whom the business owes. Expenses. Expenses are an expired cost, whereas expenditure are expired cost. Cost it is already incurred. 6. Revenue. Revenue are income which are generated after making particular expenditures. You spend so that you earn. The more you spend, the more you earn. Then finally, we come to a very critical area, principles of accounts. Now, what do you mean by principles of account? These are rules, guidance, standards, which are used in the preparation and presentation of accounts. They include 1. Concepts, 2. Convention. Now, in concepts of accounts, they are ideas which are used in the recording of business transactions. They help in the preparation and presentation of business transactions. They include the following. 1. Business entity. In business entity, business is a separate entity from ownership. There is a divorce between business and ownership. 2. Going concern. Business must be continuous. It must operate until into a foreseeable future. 3. Cost concept. All business transactions must be recorded in their historical cost. 4. Money measurement concept. All business transactions must be measured in terms of money. No money, no business. 5. Dual concepts. Dual concept states that whatever you debit, you must credit. It is a rule which was brought forth by an Italian mathematician by the name Lucas Pascalio in 1486. 6. Accrual concept. Under this concept, we say revenue is recognized whether money is received or not, whether money is paid or not. 7. Margin concept. Under this concept, expenses is merged with revenue. Whatever you spend determines what you generate. 8. Periodicity concept. Under this concept, all business transactions must be established in terms of time. For how long? Financial year is normally from January to December or from July to June based on the nature of business. Then realization concept. Under realization concept, we actually described or determine at what point cash or at what point transaction is effected. Now there are 3 critical elements that we must understand in realization. Order, delivery, and payment. Realization concept takes place when delivery is done and not when order is made, neither is it when cash is made. Finally, subsistence over form concept. Under this concept states that form comes after subsistence. Subsistence means the use of item comes before the transfer of ownership of item.